Hey, Bert Salazar here. In my upcoming book, The Paradigms of Retirement in the 21st Century, which is the first book that I write, although I have done a lot of white papers and so forth. But this book is emphasizing all of the major challenges and concerns that Americans need to consider prior to retirement. So in this particular book, I devote an entire chapter to what I call the fatal four in retirement. And the fatal four in retirement are the things that we need to protect against, that all of us need to protect against in order to make certain that we can have a successful and happy retirement life. And the fatal four are managing the risk of dying too soon, the risk of living too long, the risk of living with a disability, and then last but not least, the risk of living with eroding factors. And my definition of eroding factor is anything that can erode the value of your money in retirement. So taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, lawsuits, whatever it may be. But today I just want to take a few minutes of your time and talk about one of the fatal four, which is the one that I get often asked by many of my clients and friends that I talk to regarding financial assessment. And this is the risk of living with a disability. It is one of the major issues that all of us are going to have to deal with in retirement. Now, obviously, tomorrow is promised to no one. So, dying too soon may create a major problem. Living too long and the risk of running out of money before you run out of life is another issue altogether. But the risk of living with a disability is the biggest challenge for most Americans today. And the challenge is twofold. Number one, Americans are not prepared. They have not done any type of due diligence in order to understand the viabilities and the risk and the eroding factors that come with having a disability in retirement. So we're talking about it could be a long-term care need, could be Alzheimer's, could be Parkinson, could be all kinds of things that very few of us actually plan for. According to governmental statistics, if you're a 65-year-old couple today, there's a 70% probability that one of you is going to have a long-term care need at some point in time in the future. And in order for you to cover that long-term care need, again, according to statistics, it's going to take anywhere between $250,000 and $425,000 to cover those additional expenses in retirement. For obvious reasons, Americans are not well prepared for that. So I devote an entire chapter to not only understanding those risks, but also understanding viable alternatives and solutions that may be suitable not only for yourself, but for every member of your family as well. Now, when it comes to long-term care, there are a number of things that you can do. Number one, you can self-insure. So you can say, you know what, if it's going to happen, it's going to happen. I'm just going to continue to withdraw and take money out of my retirement accounts. Perhaps of the fact that I have a long-term care need, I'm going to have to take more. So my risk there is going to be the compounding effect of running out of money before you run out of life, because now not only do you have to take money to maintain your standard of living, but also you have to take additional funds out of those retirement accounts in order to maintain and be able to pay for the additional cost of long-term care. The other thing that you may be able to do is just go out in the market and buy a traditional long-term care policy. And there are good policies out there, but number one, they're pretty expensive. Number two, most of them, the premiums are not guaranteed. So every 3 to 4 years, the insurance companies do have the right, and they do it all the time. And they go back and raise your premium, and you can either pay the additional premium in order to maintain the amount of coverage and protection that you chose at the very beginning of the contract, or more than likely, you may have to reduce the coverage in order to pay the lower premium or maintain the premium that you were paying for, as many years as you have had the contract. So, and then the other challenge with that is that, what if you die in your sleep 30, 35 years from now? All of a sudden you paid that premium for 30, 35 years, And when you die in your sleep on the side of the angels, hopefully, then there's nothing coming back to you. So not only did you lose your premium, but you also lost the opportunity cost of what you could have done with that premium had you not placed that premium into a long-term care contract. And then obviously there's also an opportunity cost to your family because they don't get to enjoy what you would have been able to do with that premium because that was earmarked for long-term care policies. Now, over the last several years, insurance companies have understood that. So they have come out with what is known as hybrid products that gives you a combination of a life insurance contract, which will pay a death benefit like any traditional life insurance contract would do, but also they have long-term care riders that would also pay a benefit if you happen to have a need for long-term care. And some of the major carriers that I deal with, there's one in particular that I deal with for many of my clients, they provide three types of riders when it comes to long-term care. One is known as a chronic rider, and that is a one that if you cannot perform two of the activities of daily living, which actually gives you under IRS rules, the qualifications to qualify for a tax qualified long-term care benefit. If you cannot perform two of those activities of daily living, then this life insurance contract allows you, the policyholder, to invade a portion of the death benefit while you're alive in order to mitigate the cost of those long-term care needs. So instead of you having to go into your retirement assets and start to invade additional principal and interest in order to cover those liabilities, now this chronic illness rider inside a life insurance policy gives you the best of all worlds, because then you have the ability to withdraw on the death benefit in order to cover the activities of daily living that you may not be able to perform, whether it's bathing, continence, being able to move, all the things. There are 6 of them. I'm not going to go into details today on this, but those are the ones that are covered under a chronic illness rider. The second rider that is very, very important as well under these hybrid contracts is called a critical illness contract. That means that if you have a critical illness, let's say you had a heart attack or you had a stroke, and obviously you need care, or you had a transplant, and you need additional care, then the critical illness rider inside this life insurance contract does allow you, similar to the chronic illness, to invade a portion of the death benefit in order to maintain your standard of living and being able to pay for the additional cost along those lines. And then the third and last but not least of this package of riders is known as a terminal illness rider. And this one basically means that if you get diagnosed by a physician that you have 12 months or less to live, then the insurance company allows to invade the portion of the death benefit in order for you to take that money out and do whatever it is that you need to do with it, either pay additional expenses or do other things that may be very critical for you and your family prior to your death. So when you have a life insurance contract that will pay, think of a life insurance contract as money in escrow, and escrow closes the day you die. But these new hybrid life insurance contracts, not only do they pay a death benefit upon your death, but they also will pay either a chronic, a critical, or a terminal illness rider, depending on your long-term care needs and your medical situation at some point in time in the future. What I do enjoy and like quite a bit about these types of hybrid contracts is, as opposed to just buying a traditional long-term care policy, where the only way you're going to be able to enjoy the benefits is if you have a need for long-term care. In a hybrid policy, if you have no need for any of the long-term care riders that I have just talked to you about, and then you die, obviously your family and your beneficiaries will collect 100% of that death benefit on a tax-free basis, and that's a major plus. If you do have a need for a portion of the death benefit while you're alive to cover some of those critical, chronic, or terminal illness riders, then you're going to be able to use that money as well. And then whatever it remains, it will then go tax-free to your beneficiaries as well. And then obviously, if you used it all, then you used it all. So the bottom line with these hybrid contracts is that someone will always, always, always get a benefit. So that's very, very important for all of you to understand. So the premium that you're paying in order to mitigate this potential risk in the future, it's a premium that at some point in time you're going to get back, or your family's going to get back, or a combination of both of you will get back on a tax-preferred basis. Always remember that if you need to get a hold of me, if you want to pick my brains, if you want to ask me any additional questions, please feel free to do so. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at gablestaxgroup.com. And always remember that my goal for each and every one of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thank you for giving me a few minutes of your time today, and I'll talk to you again soon. Take care. Bye-bye.